And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is Tuesday. John Penn joining me this morning, and of course, it is post-tariff relief day. I'm not even sure what we're going to call these things anymore. It's we've had a lot of tariff volatility lately. That now seems to be over for the most part. Just in time for peak shipping season, because we're getting ready to go into summer. And if you take a look at the kind of the seasonal changes to shipping, we always generally have a lull right after kind of Easter, and then you pick up going into summer. And so getting this tariff out of the way just in time for China, just in time to begin the peak summer shipping season for retailers. So good news is inflation's not going through the roof, right? So summer still intact. Speaking of summer, we're in the middle of a heat wave. This week is supposed to be some of the hottest temperatures on records for this time of year. So, and no rain forever. There's like no rain in the forecast until like the end of the century. So just be aware. That's your brief weather update for the day. If you live in the Houston area. A couple of things though to get into. This week is inflation week. So we're going to have the inflation data. Don't quote me, but I believe it's Wednesday. We'll have the inflation data for CPI. So of course that's going to weigh on this, kind of discussion about the Fed. The number of rate cuts that have been expected by the Fed have been declining for this year. We were at about 4 a couple of months ago. That's now down to about 2 going out to the rest of this year. So markets are getting okay. With the Fed kind of being on hold, and that's good news, right? So the markets have been rallying despite some of this more hawkish commentary from the Fed. The markets have been doing okay now that we've got this tariff situation out of the way. Markets are performing fine. Now the big question, of course, is the recent correction over? This was yesterday's article, kind of going through the bull case and the bear case for the recent correction. I'm getting a lot of emails, a lot of concerns like, this is, it's just a bear market rally. It's going to go lower again. Well, the reasons for a bigger decline in the market are starting to fall away. And, and we talked about this before, is that generally the most dire cases of expectations generally never work out. And so we get all ramped up into, these tariffs are going to cause all this inflation. It's going to cause a recession. Recession risks are now falling again rather sharply. So once again, all the economists ran out, started claiming a recession was coming, and that's starting to fall away now. They're starting to back off that call. And even Goldman Sachs, who had about a 40% chance of recession, that's now down to about 20-25. So they're starting to pull that back and say, well, maybe we won't have a recession now. Well, this is the challenge with investing money, as we've talked about, is kind of weeding through that narrative and maintaining a focus on kind of what the markets are doing more than anything else, rather than what we expect them to do. But again, that's just part of this process that we're going through. Again, this reversal of tariffs yesterday, it's only a pause. So we're still going to have to deal with what happens in 90 days, or does this just wind up being the case going forward, right? Do we just never come back and revisit the 90-day pause? Does this just become a permanent thing? I don't know. And so there's certainly, and so when we start talking about this risk of the market, there's still a lot of uncertainty around these tariffs. In 3 months, we could be talking about tariffs all over again. Hopefully not, for my sanity. But we could be talking about tariffs again in 3 more months, right? And again, this is only China. We still haven't done deal. We did a deal with the UK. We did a deal with China. There's tariffs on 135 different countries. So we're a long way from being done with whatever these tariffs are going to be, kind of wind up being. But China was the big one. We stated this before, is that the one country that had to get resolved was China. And if Trump could resolve the situation with China, this market was going to rally pretty hard. And that's what happened yesterday. So here's what you need to know before the bell. So a couple of things yesterday important from a technical perspective. First of all, we are now very, very overbought in terms of the relative strength index. So, and that is suggesting that a lot of this rally from these recent lows has likely been priced into the markets. Now, markets can stay overbought for a while, but generally when you get overbought, markets are going to start to have a little bit more difficulty rising higher from here without a bit of a pullback first. Now, that doesn't mean the market's going to go retest lows. The potential to retest these lows is likely very low now because of what's happened in the markets. Secondly, though, momentum is now extremely overbought. So we've got two very kind of simultaneously overbought conditions. And again, this doesn't mean the market's going to crash. Just means that you're probably going to get a pullback here to some point. So if you're looking to add exposure to your portfolio, just be a little bit patient here because we're holding a little bit extra cash in our portfolio right now. We're going to just be patient here, wait for this market to relax a little bit. And it could just be a little bit of a sideways correction or something to that degree, and then you'll have a better opportunity to put capital to work. But just jumping in and buying today, you're likely going to buy a little bit high here, and you'd get a little bit better. If you'll be a little bit patient, you'll have a little bit better entry point. So let's talk about where some of those entry points are going to be, because that's going to be the real question here. So yesterday we broke above the 200 and the 100-day moving average. So we took out really heavy resistance yesterday on that rally, on that news about the Chinese tariffs. So we took out a very important technical structure there from that standpoint. So the important thing, though, is that just because we broke above it yesterday, we have to hold it now. So again, that's just because you were up above it for one day, that doesn't constitute a break, so to speak. You need to hold it. Again, if the market just completely fell apart today and went back below it, that would invalidate that breakout. So again, we're up there. We got through all. It's been an amazing rally, no doubt about this. It's been very advanced at this point. Really good running trend line from the lows. We've taken out every single level of resistance without any trouble, which has been a very important part of this market cycle. The breadth of the rally has been very strong. The number of stocks trading above their 50 and 200-day moving averages is back above 50%. The relative breadth, if you take a look at the S&P equal weighted versus the market cap weighted, it's been outperforming for the last 6 sessions, so suggesting that this has been a very broad rally, of course, and that's healthy for the markets. So we've taken out every single level of resistance here without any trouble whatsoever. So that just really shows you there's been a lot of buyers coming into the markets. Next level of resistance, honestly, is just going to be all-time highs. So there's not a lot to really stop the market from here to there at this point. But again, just with markets overbought here, look for a bit of a correction. So first level of correction is just going to be kind of holding above that 200-day moving average around 57.50. So if the market can kind of come back and just kind of bounce along that 200-day moving average, hold that level of support without breaking it, that would certainly be good. Right below that is going to be this cluster this cluster of price action and the 50-day moving average. So any pullback back to this, kind of 5,600 to 5,700 range that holds, and the market kind of just consolidates in there and then moves back above that 200-day moving average, that's going to be a good sign that you've had a really kind of both a confirmed breakout to the upside, but also that pullback will give you a better opportunity to add to exposure that you want. And we're going to get some of that. Right now, we've got a lot of corporate buybacks that's helping support this rally. Market could certainly rally higher here over the next couple of days. But again, if we can just come back, retest that 200-day moving average, hold that, that's going to give you a decent entry point to add a little bit of exposure. So you're just looking to work off some of this really kind of overbought condition to put some capital to work here. But again, this market is probably going to go higher here over the rest of this month as buybacks are fully engaged. Once we start getting into summer, a little bit different story. But that's what you need to know before the bell this morning. We'll come back, pick up with John Penn. A lot of stuff to get into, a lot of questions this week from clients and prospects. We'll get into those with you this morning right here on the Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. John Penn, how are you?
Good. Good morning. How are you?
Very well. It's Tuesday. Week's almost over. Is that right? No, not yet.
It's
Damn
getting,
it.
We're so close.
Damn it.
We're so close, but yet so far.
Damn it. Anyway, so a few things, again, just kind of talking a little bit about, the market yesterday. Just a phenomenal rally yesterday. Market rallied about 3% yesterday, so just a very, very large rally. And again, not surprising on the back of the news that we got, taking out a lot of overhead resistance levels. So a lot of these concerns about, the retest of lows or going lower, those are starting to fall away here. But as I said, markets are back to overbought here. So, as we've kind of stated before, is that, if you didn't like that sell-off that we had, and John and I were dealing with a lot of emails from people coming in, very, very concerned about the sell-off. And it's like, it's who said yesterday is like Sanford and Sons, like, it's a big one, Elizabeth. It's just we're just, you've got to navigate this. And this is why I wrote a whole series of articles during this whole process, talking about being like Spock, being unemotional, and kind of how to battle volatility and keep your emotions in check, because this is where we make all of our mistakes. And, we get too negative, we sell everything, we go to cash. And the mistake then is like, okay, well, now what are you going to do? Because now the markets are rallying. So you won't want to get back in because now markets are overbought. Now you got to wait for the next pullback, but market keeps rallying, and it gets to be just a whole psychological kind of debate with yourself that you never win. This kind of, Brent posted this list of stuff on my note page this morning, and one of them was pretty funny. It says, I hate when I hate when I see couples arguing in public, but I miss the beginning of the argument, so I don't know whose side I'm on.
Oh,
so
could y'all just start over?
Wait, I'm trying to figure out who I win. But that's the same thing with investing, right? We get involved in all of these debates and concerns and all these other, headline-driven narratives that are trying to, more clickbait than anything else. And again, the more bearish it is, the better clickbait it is. in order to get you to watch it. But then it gets you kind of emotionally askew of what you need to be doing with your money. And then the market does what it always does, which is exactly the opposite of what everybody thinks it's going to do. And this is why contrarian investing is so very important. We were writing some articles right there at the lows. And, April the 6th, we wrote an article talking about hope and the fear is that there was so much fear in the markets that's actually a very good contrarian indicator. Of course, April 7th was the bottom. But that's hard to recognize that at the time because all the other data is just, pounding you with negative information, right? Oh, a recession's coming. This is going to cause massive inflation. All that's gone now because all the tariffs went away. So, as fast as it came, it went. And so now we're back to trying to figure out what happens next. But, this has been a big challenge. I know for you, John, you've been getting a lot of calls, emails.
It's and all of a sudden now look here, after yesterday's market move, markets are still slightly negative for the year, but relatively flat. I mean, a major move from where we were, maybe 5 weeks ago?
Yeah, 5-6 weeks ago.
5-6 weeks ago. So it just shows you how quickly things can change. And there for a moment, was it April 6th, 7th when markets were kind of at their peak drawdown at that time? Yeah, a lot of emotions were just swirling because and it's we're as humans we're kind of wired that way, right? I mean, money is very emotional. Finance is very emotional. It's your well-being. I get it, right? Health, medical, that's all very emotional. But especially on the finance side, when you're in the thick of it, I think as investors, we all try to kind of take a step back and not let the media's the media headlines really affect us. But then all of a sudden you're in that storm and they're just grinding on you. I mean, the media, the headlines, the tariffs, the back and the forth, it just after a while it can wear down the most disciplined, unemotional investor. And I think sometimes, Lance, we get kind of pulled into that. Well, look, the markets are down. What was the peak down on? 18-20%?
Yep.
Somewhere around
actually
there.
19.2 peak to trough, yeah.
Okay, so peak to trough, it was 19%. Markets are down 19. It's down 19. It's like, oh my gosh, John, how much am I down? I must be, I must be getting killed. And at that time, portfolios were down. Give or take, depending on, the person I was visiting with. I mean, they were down, somewhere to 2 to maybe 5%.
Yeah.
During that period of time. I mean, look, we don't like seeing negative numbers, but if the peak drawdown is, call it 19%, if you're down in that 2 to 5% range, man, you're weathering that volatility really well. Mm-hmm. And I think this kind of proves the point or makes a point to one of Lance's previous points of, if this recent market volatility, if a 2 to a 5% move down in your portfolio is concerning, and if that concerns you, that's okay. I'm not trying to make light of this, right? I mean, but now that markets have rebounded here, if that market volatility that we had just a couple weeks ago, did cause you concern, where you were losing sleep at night, this was it, I really couldn't take this. This is a good time for you to really reevaluate the amount of risk that you're taking as an investor. And if you want to reduce or lighten up on some equity exposure, this is probably a good time to take some action here.
Yep. No, absolutely. And, this is something we always talk about is that, investing is not for everybody.
Right.
Right. And there's a lot of people that want to manage their own money and they enjoy doing it. I'm not sure why, but I think they lie. I think they say they enjoy doing it. I don't think anybody really enjoys doing it, but, there's a lot of people that do that and they're fine with it and it's good. There's a lot of people that try it and it's just, again, if you're losing sleep at night, you can't eat, you're cranky all the time, you're snapping at your spouse, you shouldn't be managing your own money and you should probably be in a very, very conservative portfolio. But this is where we start doing just the opposite. And then the market takes off and it's like, oh, now
yeah.
I want more.
Everything's fine now.
Everything's good now.
Yeah.
I got this. So now I want to take on more risk, and then as soon as the market cracks again, you're right back in that same hole where you're upset, you're losing sleep, and that just tells you that you don't have the risk, you don't have the mentality to take that kind of risk. And there's not, again, that's everybody's different, and there's nothing wrong with that. It's just important to recognize that so that you can figure out a way to invest and grow your wealth and not let your personal emotional biases, dig into you. And if you're one of those people like that, and I know many of them, but if you're one of these people where your emotional swings are all over the place, the best thing you can do is invest in a portfolio, have somebody manage it for you, and don't look at it for a year.
Yeah.
Just do an annual review on your portfolio, and outside of that, don't log into your account, don't open up a statement, don't do anything. Just wait a year, and then go look at where you are, and you'll bypass all this volatility, but your life will be a lot better. You'll just be able to navigate things better. But let a professional manage your money, whoever it is. I don't care who it is, but let them do their job, and then once a year look at it and get past this daily swing, weekly swings in the markets, because it's that volatility that leads us to making all our mistakes.
Yeah, and if I, with that last suggestion I had to just say, maybe this is a time to explore reducing some equity exposure. I'm not suggesting that, when markets are healthy, or when it's more of a, risk-off environment that, hey, I'm going to load up more in equities, and then when it gets to be a more aggressive time, hey, I'm going to reduce. I'm not suggesting that you need to kind of bounce all over the place here with your allocation. This decision, if you are maybe wanting to kind of take some risk off the table here, it needs to align with who you are as an investor. Like, what is your true risk persona? And sometimes, Lance, I see folks that kind of ping pong around a little bit. Well, I want to be aggressive now. I want to be conservative now. I want to be aggressive, and it's like a monthly rotation. And typically, it's there's a great quote here. The more you handle your portfolio, it's like a bar of soap. The smaller it gets. Right. So if you can, so what I'm suggesting here is, if you're going to make a decision to maybe take a little bit of risk off the table, align your investment approach with who you are as an investor, as a person. I'm not suggesting here that you're bouncing around 1 month to the next, because typically that does not end well, or it does not give you the outcome that you're looking for. Right.
Yeah, no, that's true.
Yeah,
that's very true. So anyway, enough of that. Kind of beat that horse a lot this week, but the important thing here is that tariffs are over for now, right? For the most part. I mean, we've got the rest of the negotiation. They're not over. Look, let me rephrase that. The tariffs are not over. We're still in negotiation with a lot of countries, but the big one got done. The only one that really mattered to the markets was China. That was the one. Canada will get worked out. Japan will get worked out. Mexico will get worked out. They're all going to wind up at some lower level, 10%-ish or whatever. The market's already kind of factoring that stuff in. Now, could there be some other shock announcement coming out of this administration? You betcha. That's one thing about this administration that you should not discount, is the ability for some shock announcement to come out. I mean, their agenda is very different. It's very aggressive, and we'll go from there. By the way, the Treasury just announced the largest budget surplus in ever. So one of the largest budgets. I can't know what to say that this morning. Budget surpluses on record. So there you go. So it's not the end of the world after all. All right, be right back after the break. More with John Penn. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I'm a little disappointed. I was expecting Crocodile Dundee to come back from this trip and have alligator tooth necklaces or some tribal tattoo, where he was adopted by some tribe.
The Real Investment Show podcast.
You don't know what I'm wearing underneath this suit.
Same show, your schedule.
You didn't come back married to some tribal princess or something?
No, I did not. Yeah, I can barely keep up with one, much less multiple.
At realinvestmentadvice.com.
They must have some really good time management.
Exactly.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
I was in the first segment this morning, I said inflation data was tomorrow, Wednesday. I was wrong. It was today. It is today, 7:30 this morning. We'll get the consumer price index month over month. April's expected to be up about 0.3% expected versus negative 0.1% last month. That's year over year kind of rate of change. Year over year, it's expected to stay flat at 2.4%. So we'll see. Again, a lot of potential concerns over kind of tariff front running, people running out buying stuff ahead of tariffs might have boosted prices, temporarily. So we could see a little bit warmer print, but that will likely reverse as we go into the next month. Personal consumption expenditures still very weak and continuing to slow down. Economic growth rates are slowing down. Employment growth is slowing down. So that's all going to lead to weaker rates of inflation later this year. But, again, you can have these little bumps and variation along the way. So we'll see what it says this morning. So futures kind of a little bit tentative right now going into that number. There was a recent study out. Wergler and Laritz did a study and said that before they studied what the average time was that investors use in researching a stock before they buy it, and the results are, I guess, not surprising to me. Because
I'm not surprised, but slightly. I was surprised at the amount of time. I was surprised at that figure.
Yeah. And because again, it's you're investing money, and again, it's like I was talking about the other day about my neighbor, buying a drill, right? And And he'll go out and he'll research every drill on the markets and search for the best price. And I mean, literally, he agonizes over these purchases to a very large degree. I'm not that way. It's like, I need a drill, I'll go down to Ace Hardware, buy a drill, come back home, right? It's just, I don't care. But he agonizes over this stuff. But then when he tells me about buying stocks, it's like, oh, well, how'd you do the research on that? It's like, oh, well, so-and-so told me about it. I'm like, I got it. So the study was done, and I guess, would you find the results surprising? Yes, no?
Somewhat. I mean, So here, this is what I was surprised. Well, not really. I guess I really wasn't surprised with honestly, I feel so blessed to say with all of the folks that I visit with, all over the country, I'm not surprised at this. So basically, the median investor, the amount of time that an investor spends researching stocks before buying them is 6 minutes. 6 minutes.
I thought one of the surprising pieces of data in there is that investors spent, this is from the study, investors spent most of the time of their research focusing on a price chart of recent performance. 73% of price chart views look back only 1 day or even less.
Yeah. Mm-hmm. And another key point here. About 14% of that research time is devoted to analyzing the underlying company's earnings, dividends, and other fundamentals, kind of like a balance sheet, cash flow, sales, earnings per share, revenue.
Now remind you, 14% of 6 minutes.
Yes.
Right. So that's like a dry, like, let's say fundamentals.
Mm-hmm.
Oh, there's a chart of revenue. Okay, it's going up. Good. All right. So
exactly.
We're good.
Yeah. So just very, you're right though. It's amazing how, like, folks they'll research about, vehicle purchases, or, if it's home improvements or whatever it might be. And just, I've seen so many spreadsheets out there about, cost analysis on various products that folks want to buy. But it seems like when it comes to investing, we just, okay, well, my neighbor said it's good, so I'm going to throw some money in it, Lance. And all of a sudden it doesn't work out. It's like, well, I can't believe I lost money on this. What happened? Well, did you maybe look at kind of what does the company do, and did you look at the fundamentals, and hey, based on the type of economic environment that we're in or where we might be going, how might that particular business behave? No.
Yeah.
I thought it was just going to go up in value, right? Yeah.
So yeah, I'm going to throw a question out to chat. How many of y'all ever bought a stock where you bought a stock of a company you weren't even sure what they did? Just because I know quite a few people who own. If we go through a portfolio of stocks that people own, you will be amazed at how many people don't even know what the company does.
Yeah.
It's like, why do you own this stock? Well, it was going up, or somebody recommended it to me, or I heard Jim Cramer on CNBC said buy this company. I have no idea what it does, but it was going up, and then that's way more common than you can imagine.
It is.
And, it's interesting that, especially if you have a portfolio that somebody else has bought you all the stocks. And again, even if you have an outside manager managing your money, you should at least be aware of what you own and maybe why you own it. And that gives you some good fodder as to why, when you go talk to your advisor or talk to your manager, whoever it is, say, look, you bought this company. I don't even, what do they do? And that's a good test for them, is that to make sure that they're buying companies they understand, that they've done the research on, and they understand why they own it, right? So it's a good test, because I will tell you, I run into a lot of people who really have no real idea about fundamentals. I got into a big debate yesterday over Google with a guy on X, and he was like, Google's so overvalued. It trades at 17 times PE, right, on a forward basis. And, well, yeah, but it's going to lose search to everybody else. There's no evidence of that right now. And so, sure, could it lose some search in the future? Absolutely. But they have a tremendous other lines of revenue growth that they're doing, from AI to data centers to a whole variety of other products. So, it's a juggernaut in terms of revenue growth and building value upon itself. And so just because it looks like it's expensive doesn't necessarily mean it's expensive. But these are these kind of false narratives that we run into or things that we believe to be true that really aren't, and because we're not doing the research.
Yeah, I think it's very common where I visit with folks, and they've got a whole myriad of portfolio holdings. It's like Beanie Babies. They've just been collecting them over the years. And there are times where I'll go through, and I'm, maybe they're working with another advisor, and I go through and I just spend time with their statements. I'm like, look, let me just get an idea of kind of what you have, where it is. Let me get the lay of the land, and let's walk through this together. And I'll go through the list of investments. I'll say, hey, do you understand what this is? Do you understand how this works? And sometimes it's yes, most of the time it's no. Even with mutual funds or exchange traded funds, a lot of folks don't understand what an ETF is, and that it owns a basket of securities, and those securities will affect share price, et cetera. So what I appreciate about the team here is all of us, Rich, Danny, myself, Matt, Sarah, Frank, all of us, all the advisors. We visit with Lance and Michael several mornings of the week, and we're talking. And Lance and Michael are leading those discussions around the markets and risk, et cetera. But we all get together and we talk about here's what we own and why. So that way, when we visit with clients, because we want to visit with you throughout the year to get what's changed. Do you need to start taking some income? Let's go back to your financial plan, but let's talk about the portfolio. Here's why we have you allocated the way we do. Here's what we own and why. Because at the end of the day, these are your dollars, right? That you're out there working hard for. So you need to understand, why is it positioned the way it's positioned? And if you're working with an advisor and you're not quite sure what the strategy is, or you're not quite sure why they own what they own for you, ask them. It's okay. It's your dollars. You have the right to ask, so that way you have a better understanding of what is your money, what's the objective, right?
Exactly. But again, there's this is one of the challenges that we kind of run into as investors. Is that again we'll go spend hours researching to buy a drill or a television or whatever it is, but we spend no time spending time to research and understand what we're investing in, and then we wonder why things don't work out well.
Right.
And again, that's this also, doing your research on companies and understanding them also helps you weather when you have these downturns in the market. Because when these downturns occur in the markets, instead of panicking, saying, oh my gosh, I'm losing all this money, you really don't understand what you own. If you understand what you own, you say, okay, I'm gonna take a little money off the table now. But I'm going to be looking to buy that stock back and add to it at cheaper prices, or when the market is coming down, even if you don't trim it off, but as it's coming down, you say that's still a great company, right? Eli Lilly, AbbVie, Amazon, whatever the company is, you buy into those positions at cheaper prices because that's how you make money over time. But you can't do that if you don't understand the fundamentals and you're just following a price chart from the last 24 hours.
Well, exactly. So if you understand what you own, if you understand what the companies are doing, like if the market pulls back, it could be we all get so scared about running away when markets are pulling back. Hey, there's an opportunity where maybe you can buy something at a better value, right?
Well, there was a comment in chat about, well, isn't that what ETFs are for? ETFs are fine. There's nothing wrong with investing in ETFs. If you're not going to do the research to invest in individual stocks, ETFs are fine. You will perform with the market. You'll get average returns over time, those type of things. So there's nothing wrong with owning an ETF. But if you want to create better returns, more stable returns over time, more income for your portfolio in terms of dividends, then you want to build a portfolio of individual equities. You will do better over time. But again, there's nothing wrong with either approach. You need to find what works best for you. And if owning a basket of ETFs works for you because you can withstand the volatility, you don't worry about drawdowns, those type of things, nothing wrong with that. We run an ETF model just for those reasons. So yeah, it's all about psychology at the end of the day. All right, we'll come back. Get ready to wrap up the show. Don't go away.
Get Daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So talking a little bit about doing research on stocks, maybe we can dedicate a show one day to kind of going through kind of some fundamental analysis tools, those type of things. Again, just as investors, there's so many free tools that are out there to use. I mean, pretty much you can just go to, Google and type in, give me the fundamental rundown of, Apple, right? And you'll just get tons of information to kind of do your work. You'll get a lot of opposing opinions, and that's okay. You'll get people saying, oh, it's just so overvalued, or hey, it's cheap, or whatever it is. But that's okay because, again, getting different opinions, it's like looking at different reviews for a restaurant, right? You got to kind of sort through the good and the bad, analysis, but then it helps you build a better overall analysis for your own, investing purposes. So, again, spending a little bit of time, certainly never hurts.
Yeah, and sometimes folks will ask me, so John, where do I start? Where do I even start? Maybe even researching for ideas. And my suggestion to them is, just take a moment and focus. Just take a moment during the day and focus. What are the things that you use every day around the house? Household items, electronic items, whatever that might be, and you kind of think them through. Where no matter what type of economic environment we get in, are you going to continue to use that product, right? And so you'll get familiar with these. And then from there, take a deeper dive and really look at, okay, well, how are they structured? What does their income look like? How have they done in times of stress in the past, right? So that'll kind of help you start getting your arms around this, because I think sometimes, Lance, you look at the universe of all of these different investment opportunities out there, and I think folks can get very overwhelmed very quickly. Mm-hmm. So I think that's a good place to start. Just what do you already know? Like, you use this stuff every day, so let's slow down and take a look at it.
Right. That's some of the greatest, kind of investing commentary or investing advice that has been given out, over the majority of years. Is to, Warren Buffett said it. The manager of the Fidelity Magellan Fund, I'm drawing a complete blank right now.
Peter Lynch.
Peter Lynch. Thank you so much. Peter Lynch was famous for saying it. I'm 60. I've got dementia.
You need more birthday cake.
I've got dementia. But anyway, Peter Lynch was famous for saying it's like, buy what you know.
Yeah.
And, don't worry about all this stuff that's coming up. And, again, it's interesting, when it comes to something like Bitcoin, right? You have all these people say, oh, buy Bitcoin. Most people have no idea how it works, right? And then the people who claim they know how it works come up with all these false reasons for why it works a certain way and why this is this way or that is that way. And most of it's wrong. But we all have our biases. So if you don't really understand, what a company does, it's okay not to buy it. Warren Buffett didn't own Apple forever.
Yeah.
Right? He didn't own any technology stocks in the late 90s. And I don't buy what I don't understand. Right? So Warren Buffett, famous, right? He eventually bought Apple later when he finally understood it was changing the world, right? But this is the whole point about investing is it's okay. This is the point. It's okay not to own something that somebody else owns, right? Follow your 10 commandments, right? Don't be envious of somebody else's, don't covet thy neighbor, right? So, don't be jealous of what they own because it's going up and maybe yours isn't, because their stuff that's going up, if it's super speculative, it's going to crash and they're going to wind up losing a bunch of money. See this all the time, right? So, buy what you know, buy what you're comfortable with. If you shop at Costco, we own Costco because my wife is at Costco every other weekend buying steaks. Best steak. You cannot get better steaks than at Costco, period. Hands down, right? So we own Costco in our portfolio. My wife shops at Amazon. Are you getting the hint about our portfolio now? We own Amazon. So it's wherever my wife supports, right? Those are the stocks we own.
Is that why we have Walmart in the portfolio too?
That's why we have Walmart.
Okay.
3:00 in the morning, Crocs and shorts, Walmart, right? If you want crazy people, go to Walmart at 3 in the morning. Cheap entertainment, yeah. Absolutely. But seriously, it's you own the companies that you do business with. You own the companies you understand, because you'll be better. Again, this all goes back to psychology, is that we can weather a downturn because I understand what that company does. I know that the market's going down right now, but Costco's not going out of business, right? Market's going down right now. Walmart's not going out of business. Market's going down right now. Amazon's not going out of business. Those are the things that we want to know, right? And then that helps us to navigate these downturns in the market so that we can survive and come out on the other side of this in a much better position.
Yeah, and just letting you in a little secret here, which you probably already know, but if you're talking with your neighbors and they're telling you how wonderful their portfolio is and all this money that they're making, they're not going to tell you where they're losing their shorts either, right? I mean,
nobody tells you about the losses.
Yes, we're out there cutting our yards with each other. It's like, hey, Gary, come on down the street here. Let me just tell you about the bath I took on this stock I just bought. That is not the conversation, right? It's usually, oh man, I'm making all this money, blah, 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 blah.
Yeah.
They're not.
It's party talk.
It's party talk where you look at, and I'm not on social media. I don't, I'm not a Facebooker or whatever. I don't know what the term is anymore, but you look at everybody else's lives and their pictures and everything looks perfect. That's a snapshot in time. Is that really going on? I highly doubt it. Just saying.
Yeah.
Just putting that out there.
JP in our chat says he's never been to Costco. I think you're lying. I don't know anybody who's never. If you've never been to Costco, go to Costco for the $1.50 hot dog.
Yeah. There you go.
Best hot dog you'll ever have. Free samples. Yeah, and free samples. I mean, you can literally just make an afternoon at Costco. So if you haven't been to Costco, just go. But it's a racket. So last weekend, my daughter's graduation party, high school graduation party, is this coming Saturday. And so last weekend we went to Costco to get plasticware and paper plates and all kinds of stuff because you can buy it in bulk, right? So there's going to be she's got I don't know. I have if I died tomorrow, I think 2 people would show up to my funeral. Somehow she's got 80 friends. And she's in dance and all this other stuff. Anyway, so they're all coming to the house. So we went to Costco. Well, we hadn't been to Costco in a couple of months. Right. And so we went into Costco, and the first thing they know, it's like, your membership's expired. So you got to up that membership. This is the one thing about Costco that people overlook when looking at the value of Costco. They create several $1 billion a year just in membership fees.
Yeah.
Period. So and what that means is that's what's called an annuity business. That means on January the 1st, and this is the one thing about your portfolio as well. If you can turn your and this is what I mean by turning it to an annuity, right? You structure your portfolio so that on January the 1st, you look at your portfolio and you know that already you've locked in 3 or 4% return in your portfolio. Guaranteed. How do you do that? Interest on bonds, dividends from stocks. That's not going to change. So if I can build, if my portfolio is to generate 6% a year, which is what our goal is, if I can lock in 4 through dividends and interest, or 3, whatever the number is, I've already got half the work done. So now I just have to worry about the other 3%. I don't have to worry about starting from 0 every single year to do that. Well, that's the same way with Costco. Costco opens up their door every single year, January the 1st, and they already know, oh yeah, well, we've already banked, $2.3 billion in revenue this year. It's going to be a good year, right? Because all those memberships are going to renew. And that doesn't even count the new sales for new memberships, right? Every year. So it's just a huge annuity business. That's the same thing with Sam's Club at Walmart, right? Another reason why we own Walmart, because Sam's Club isn't public. But you kind of get the same effect through Walmart stock. But those are the type of businesses that you really want to invest in. If you can find a business that's an annuity, or they have an annuity type structure in their business, it's going to survive downturns in markets.
Yeah. Now that doesn't mean that those equities are immune to market volatility.
No, of course not.
Right. So that's not what we're saying. I mean, Costco, Walmart. I mean, earlier this year when markets were pulling back, they were pulling back too.
Sure.
But they've also recovered very well. I mean, I think Costco's up close to 11% for the year now.
Right.
But to kind of to the earlier points that Lance was making is, if you buy high quality businesses that you understand and you look for those businesses that have that annuity structure, that recurring inflow of revenue, that doesn't mean that they're immune to market volatility. So even as an investor, you have to be willing to accept that volatility to own these businesses, right? That doesn't make them immune to volatility, to the downside. Right.
Yep. Absolutely. So just this is the part about investing and things like that. But again, just, kind of going back, investing what you know, buy what you know, you'll tend to do better over time. And because again, the whole point about this is there's so much, news headlines, tariffs and, what Trump's doing or what Trump's not doing or whatever it is. There's so much of that just bleeds over into market, kind of emotions. But again, just, if you can just strip out all the headlines and just get back to what matters ultimately is fundamentals. The volatility isn't that important. That's what weighs on us emotionally. But if you can just strip the emotions out of it, turn the headlines off. And again, this is why I've told you before when I'm, working on our portfolios and doing those type of things, I don't have CNBC on. I don't have web pages up with news headlines. And a lot of times I don't even have real-time market data up because it distracts me from doing the research on the companies that we own and, doing the analysis on the portfolio, the weighting structure of the portfolio. Yes, I'll look at markets, but it's a very secondary factor to all the other stuff that's much more important, which is the fundamentals of the companies that we own. So anyway, hope that helps. Hope you have a great day. We'll be back tomorrow with Danny Ratliff, and we'll catch up and we'll have some markets today. We'll talk about inflation tomorrow and see what these numbers look like when they come out this morning. See you then. Have a great day.